Hi, this is Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. And last week, I recorded an episode about, really just analysing the idea of investing 100% of your super into a internally geared, diversified ETF. And that was episode 411, just in case you want to go back and have a look at that. I actually got a question from a comment on the website, on the blog on the website, and actually from Dave. And I've just added another paragraph underneath the blog to deal with that question. Anyway, Dave pointed out that a provider called Perla, they have a super product, and Perla is the online trading platform. Actually pretty good. It's got some interesting functionality around dollar cost averaging, automated investing, these sorts of things. I note that actually BetaShares Direct also has a similar, and BetaShares Direct is a free platform as well. No trading costs, no trading commissions, whatever, when you buy ETFs on BetaShares. Anyway, I had a look into it. Perla Super does allow you to establish an account and invest your entire balance in DHHF. In last week's blog, I said, well, trustees are always going to have an issue with that. So it's kind of interesting. I don't know if that's going to be around for a long time and what ASIC might think of that and so forth, but it's a potential alternative to having a self-managed super fund. But with respect to Dave's observation, I said yes, but the problem is Perla Super doesn't offer pension accounts. So one of the benefits of using a self-managed fund is that when you convert to pension phase, or any unrealized capital gains disappear, which is it reduces that tax drag on the balance. So that's a really attractive situation. Plus also, if you have a self-managed super fund, you eliminate the risk that products change or discontinue or are discontinued. So for example, if Perla doesn't work and they wind up the product in 5-10 years time, you've got to find a new home for your super. You're going to have to sell the investments and crystallize the capital gain, etc. Whereas if that happened, you could just transfer those ETFs onto a different platform if you had a self-managed super fund. So I'm not dissuading anyone. Certainly not saying Perla Super is a great solution. I'm just saying theoretically it can do what I was saying at a very low cost, but there's some pros and cons you've got to kind of navigate of putting all your super with one product provider, and that product provider might change. Like for example, if ASIC think we don't like you allowing people to put 100% of their super into this one product, they might end up changing the rules, and then it forgoes the whole actual reason that you approached to begin with. So it's a funny, and I only did the episode really just considering the theoretical merits of internally geared ETFs rather than necessarily concluding everyone should do this. But I just wanted to add it. I appreciate Dave's comments, very helpful. And of course, it's impossible to be across every single product opportunity out there in Australia. So I always appreciate it when listeners provide that feedback, and where appropriate, I'll come and share that feedback like I have today. Okay, let's get into today's episode. And the first question is from Andrew. Andrew is a doctor, still doing specialist training. It's a long email, but I'll just sort of give you a bit of a rundown. Income's around 250 and fiance is around 120. They've got an investment property in Toowoomba they bought a couple of years ago. It's worth 830 with 620 of debt. About 155 grand of ETFs, about 220 of cash in the offset account. So the net debt against the investment property is 400. And sorry, the offset is 270. It is the super that's 220 plus 75. Not really relevant, the super. They've got some insurances. Essentially, there's a lot of changes going on or expected. So they'll be moving back to Perth in 2027 and doing some more training, then going to the UK for 12 months. That's in mid 28 and 29, and then returning back to Perth mid to late 29 and work as a consultant where income will increase substantially between 4 to 600,000 or more. And really what Andrew's wanting to try and work out is what to do. Should they go and buy a property in Perth because they want to ultimately live long term in Perth? They'd like to live by the beach, but they probably can't afford borrowing capacity and cash flow flow-wise to their forever home. So their thought is that they'll get some exposure to the Perth market. Sorry, the complicating factor is that they would like to start a family as well, and potentially to start a family at the second half of this year, and which means that the partner will be without an income for at least 6 months, maybe longer. So, cash flow and borrowing capacity will change a lot over that time. And when they're working training overseas, partner won't earn any income, and Andrew's income will be lower as well while working in London doing more specialist training. Now, to add over the top of this, the complexity around the proposed changes to negative gearing also. And I thought it's a good opportunity for me to sort of talk through how I'd approach this. I think it's kind of an interesting situation where we've got these proposed changes. How do you navigate these changes and still make good quality long-term decisions? And so, the next few weeks of answering these questions, or maybe actually a few months of answering these questions, will be kind of good because, one, it'll help people maybe try and help people sort of navigate how the uncertainty around taxation laws at the moment impact decision making, but also, how to weigh these things up as well. So it'll be kind of interesting, and I think it gives an additional dynamic to these Q&A episodes, given the backdrop of uncertainty. So let's put aside for a second the proposed changes to negative gearing, which, is going to make a considerable difference here. If Andrew was to go work overseas in London for 12 months, because, if it's a contract position and there's a finite sort of period of time he's going to work there and come back here, then arguably he will still be an Australian tax resident, or at least the ATO could argue that. That would be good because it means that they can still claim lower capital gains tax, as well as potentially the main residence exemption if one of these properties becomes a main residence. But if Andrew is to become a non-tax resident, then because he made comments that he could continue to claim the main resident exemption, that's not available. And we actually don't know what the impact will be for capital gains tax for non-residents as well on property. So there's no capital gains tax for shares for non-residents, but for, there's taxable Australian property, they call it, there is. So it creates some complexity there. But I think so all I'm doing there is just pointing out the non-resident taxation considerations and issues that people need to take into account when planning, because if you're going to become, or there's a risk that you're going to become a non-tax resident down the track, then putting more capital into property is less attractive in those circumstances versus ETFs. Anyway, let's put it aside for now and let's just assume that he will remain a Australian tax resident. What would I do if I was in Andrew's situation? Well, I think the main focus, and it's really good to sort of zero in on it, I actually had to sort of pause the record and think about it for a bit, but the main focus really is to negate the risk that you're going to have to pay a lot more for the family home in 4 or 5 years' time when Andrew eventually returns to Perth. So, and that cost is going to be paid from an after-tax basis, in that you're either going to have to borrow and repay a loan or save money on an after-tax basis to make up for that difference. So let's say the forever home costs $2 to $3 million today. In a normal market, what would that cost in 4 or 5 years' time, assuming Perth continues to grow at the same rate that it's growing at the moment? And so the difference could be, that property might then cost 3 to 4 or 4 to 5 million. So that's the gap that we're trying to deal with, so that we can get Andrew into a situation where he can buy that forever home and the debt isn't so bad that it's going to soak up all the surplus cash flow, at least not for a very prolonged period of time. So it then allows him to make additional super contributions, invest in ETFs, do all the other stuff that you want to do to sort of build wealth. So the tax changes in terms of the negative gearing changes aren't that important in Andrew's situation, because they're only relevant for the next 1 to 4 years. But ultimately, longer term, if we go and buy a property in Perth, it's really going to be a main residence. So that's not a concern. Now, Andrew says he's going to move to Perth next year to do some more specialty training and will be earning about $180,000. Let's assume assume that his fiance won't be working because they've started a family. So I guess that's the other thing too, is we need to think about affordability and whether they're able to buy something that is really going to be a higher quality enough to have a foothold in that market. So to negate the risk that land values go through the roof over the next 4 to 5 years. I'm not saying they definitely will. I'm just saying, well, that's the risk, right? And that's what we're trying to negate. But I don't know really if that's going to be doable. And if it's doable, it's probably going to require selling the ETFs and selling the Toowoomba property and putting all that equity in the Perth property. But even then, on a $180,000 salary, assuming that, whether you occupy it, you might occupy it for a period of time, you would, to treat it as your main residence. But whether you then put a tenant in it and go rent somewhere else, I think it's pretty difficult, to make it work. So I think in Andrew's situation, I would lean towards investing money in ETFs. I would treat the 270,000 in offset as really a bit of a buffer and also a buffer to get you through, starting a family, these sorts of things. And if I was in Andrew's situation, I would put all my surplus cash flow into ETFs. And if there was a market correction, I would probably borrow against the equity in the property in Toowoomba if I could. And I think he probably could, especially since he's a medico, and use that as some gearing as well. Of course, the Toowoomba property will still maintain the negative gearing status. And also, if we borrow to invest in shares, as I understand the legislation, that's not going to stop me negatively gearing that as well. And the reason why is I think it gives more flexibility in case Andrew does become a non-tax resident in the future. And also, I think it's going to be too difficult. I think it's going to be too difficult to buy the right asset in Perth. Plus, also, I think, if we think about it, everyone's got negative gearing regardless of when you bought the property until July 27. After July 27, established property that was purchased after budget night no longer gets negative gearing. Then in May 28, we're probably going to have a federal election. So it's quite possible by the time we get to July 27, sentiment could be such that Australians think there's going to be a change of government and the policies of that new government might be we're going to reinstate negative gearing. So it's really possible that over the next 2 or 3 years that a lot of people, property-wise, unless they're owner occupiers, are kind of in a holding pattern, as in we're not going to do anything. We're going to delay the decision. We'll delay the decision to 27. We'll delay the decision to 28 until there's election. So that could really curtail, take sort of 30% of transactions out of the market, that could really curtail growth. It's possible that the market just might move sideways for that time. So I think in Andrew's situation, if we want to buy in 4 years' time, I think the next 2 or 3 years could be such that the market doesn't do a whole lot. And then we're retaining our negatively geared asset so we can get some tax benefits, which are important, especially since Andrew will be the sole income earner at some point. And so after tax cash flow starts to become more important. And then it'll allow us to aggressively invest in ETFs. And, if we use a value aware sort of approach so that we're looking for parts of the market that exhibit strong value, like Andrew owns VVLU, which is Vanguard's global value ETF. Those sort of holdings will hopefully pick up good returns over the next 4 or 5 years, added with a little bit of gearing from the Toowoomba property. I'm not saying he's going to bridge that gap between the potential growth, because the market does kick off over the next 4 years, then, maybe not. But I think based on what we know today, I think the market will move sideways. I don't think we'll see the same level of growth that we've seen. Could be wrong. And at least it also allows him to pivot as well. So if he gets back to Perth in 27 and actually the changes aren't enacted as proposed, or his situation is slightly different, he can pivot and he can say, okay, I'm going to sell all my ETFs now and put it all into property. I'm going to sell Toowoomba and put it into property. But I think for now, I would focus aggressively on growth, as in buying ETFs, use that buffer to get through the period of having a child. And that can be a difficult period as well. So you don't want to overcommit or, get yourself in more debt. I think use the asset base that you've got now. And then over the next couple of years, if any of that sort of changes or your plans change, then of course you can pivot. So I don't think I would go and buy a property in Perth now if I was in Andrew's situation. So thanks, Andrew. That's a really long-winded answer, but I did want to just sort of talk around how we're going to deal with this issue. And as I said, it's a good learning exercise, whether it's these tax changes or future tax changes. There's always something that's changing that we need to kind of navigate. There's always uncertainty. Anyway, all the best, Andrew. Cheers. Okay, next question is from an anonymous listener. A bit of a rundown. 49 years old, salary is 475,000, 920,000 inside super, 7 investment properties worth about 6.7 with about net debt of about 330,000. So this listener has been busily repaying or offsetting investment loans, actually has nearly 1.7 of debt but 1.4 or so of cash in offset accounts. And their plan has been exactly to do that, is to spend the next 3 years repaying the rest of the debt, have zero debt against 7 properties, live off the rental income. They expect rental income is about 175,000 after tax, and that'll be enough to pay for annual property and personal expenses. And there you go, you're off to the races. You can enjoy the rental income, avoid paying any capital gains tax, and then once you're 60, access super. So, certainly that works on paper, but starting to think maybe should sell an investment property, maybe should invest in shares, or maybe move some money into super. And the listeners asked me for my thoughts in this regard. Well, I guess the first thing you want to really think about in this situation, really any planning, is to work out, well, what is the end game here? Like, is it to enjoy retirement as much as possible in the first, couple of decades? You might recall a few months ago, I recorded an episode, The Real Risk in Retirement is Working Too Long and Not Spending Enough. That was episode 204. So, this is a really good example of why it's important to plan these things out. You say, look, I'd like to avoid paying capital gains tax. That's good, but do you have beneficiaries to leave some of that wealth to? Is that really the aim? For some people, it might be, making large donations when they pass away. Other people might be giving a lot of money to children. So that's really the starting point, is what is the end plan? What would you, because that's the whole point with financial planning, is that you want to plan for your ideal situation, not reverse engineer it and just go, well, that's how much I need to live, and then not really think beyond that. Because it's great to live off the rental income, but ultimately what you want as an investor is you want strong absolute returns. So by focusing on income only, just saying, well, these assets are going to give me this income, that's great, but what is the absolute return? So the total return over the ownership period. That's what you want your money to work hard for you, not the other way around. So if the situation, there's no mention of partners or children, and that might be just omitted, or maybe they don't exist. But if there was no partners or children and no plans to leave a big pot of wealth when this listener passes away, then I would say to you, who cares about paying capital gains tax? It's really just about making your money work as hard for you, reducing risk, creating greater certainty, and then maybe opening up a higher standard of living, maybe earlier in life, doing more travel, doing those sorts of things. So if you have to crystallize a little bit of capital gains tax to get there, it's no big deal. I guess as a general observation of relying on rental income, I can share a couple of observations just from my experience of dealing with clients. The first one is that land tax becomes really insidious. So if you hold property for a really long period of time, the amount of income that you get from the portfolio actually can decline, because land tax continues to really escalate and you pay more and more land tax, and obviously it eats into the net income that you're receiving from those investments. The second consideration is the uncertainty around cash flow. So I guess you can have a vacancy, and even if you don't have a vacancy in terms of the property being vacant for a few weeks, even if there's a new tenant that moves in the day after the old tenant moves out, you've still got another letting fee that you've got to pay your managing agent. So vacancy or tenant turnover still creates a cost. But the biggest thing with property is the unforeseen maintenance expenses, which is they're not unforeseeable. I guess we all know property requires ongoing maintenance, but the timing of that maintenance can be challenging as well. So in a situation where you've got multiple properties, like 7 properties, I know I've got multiple investment properties, and there was a period earlier this year where almost every property we owned had some sort of maintenance request. We actually started to get a bit annoyed about it, actually. And sometimes you go through periods where you don't get a maintenance request for 6 months. So, that if you're relying upon that as income in retirement, arguably you want more certainty in retirement. You want to worry less about money, not more. And so property can be challenging in that regard. I've also spoken a lot about utilizing your maximum transfer balance cap, which is soon to be $2.1 million. So that's the amount you can have inside super that's tax-free. At the moment, let's say this listener's got about 6.7 million of property. Let's assume the loans have gone. That's a lot of wealth outside of super. That's a lot of wealth attracting a lot of capital gains tax. And moving forward, the amount of capital gains tax that this investor will pay will be at least 30%, which is not ideal. Having said that, if you go and sell a property, hopefully you're crystallizing a pretty large capital gain anyway. And so hopefully your taxable income is north of 200,000, in which case you're going to pay 30% tax anyway. The other problem is that these person's 7 investment properties are all located in Melbourne, and there's one house, but otherwise mostly apartments and villa units, which means that there hasn't been a lot of growth over the last number of years, which is not ideal because these properties will need to be revalued at 1 July 27, which means that most of their gains, if this person holds onto these properties for another 20 years, most of the capital gain will be measured using the old or new indexation system and the minimum 30% rate. So it's an unfortunate situation where what you really want is most of your gain to be kind of pre 1 July 27, and that will then be able to utilize the old 50% discount. Well, because anyone that owns assets in Melbourne and have bought those assets in the last 15 years, unfortunately, if Melbourne does kick off, all that new growth will be taxed at the much higher rate. And remember, what we're most interested in is the highest absolute return after tax. And so if I'm paying 30%, well, actually the effective rate ends up being between 30 and 35% of my gain, then you need to really think about whether that asset is performing for you, because you could put all that equity into the share market, particularly inside super, and you're not going to pay any tax. So the tax drag is real, even though you don't intend to sell the property. I guess it comes back to your goals. So if you don't have any beneficiaries to leave it to, well, you may as well spend it because you can't take it with you. If you do have beneficiaries to leave it to, well, then you need to think about, if they're not charities, then you need to really think about the tax consequences. So I would say that I probably wouldn't rush into selling any of these properties because they are all in Melbourne, and you'd want to enjoy a little bit of capital growth before you did. But I would say if I was in your situation, I would most likely sell quite a few of these assets, I think, in 5 to 10 years' time, and gradually move more of that money into super. In terms of which properties to sell, you really just do make an assessment on the quality of the asset and therefore your future expected returns. So I wouldn't measure it necessarily on the amount of capital gains tax you'd pay, but really it's all about future returns. So sell the dud assets first, the inferior assets first. I would hang on to the house. There's one house in Brunswick West that this person owns. I'd hang on to the houses. I'd sell the apartments probably first because they're likely to be the inferior properties. Potentially selling some properties in a family trust. I mean, there's some properties in a family trust, they're going to attract more land tax. So it's really thinking about not just one thing, but many things. Also what the market is doing, how attractive and easy the properties are to sell, whether you've got to make any substantial improvements to the property, get it ready for sale. There's a lot of factors that you need to consider, but I probably wouldn't, as I said, do anything for the next 5 years. Sounds like you've got a good plan and you've got the ability to retire now, even if you wanted to. You don't have a lot lot of net debt. So it's not that big a deal. And you've got an exit strategy as well. You can always sell one property. So you're probably in a position that you could retire tomorrow. Don't necessarily need to work for another few years to get the debt down to zero. But I think I'd hang in there for at least the next 5 years. Let's see what happens with all these taxation changes, maybe a change in government in Victoria, and see what impact that has on property prices. And then as you approach 60, get selling and getting more of that money into super would be ideal. If you're going to sell a property, you just want to make sure the capital gain and all the rules that as proposed go through, you just want to make sure the capital gain is going to be large enough. So you don't want to sell a property and only crystallize a capital gain of 60,000 because that's going to be taxed at 30%. You may as well then sell two properties and get your taxable income over 200,000. So at least you're paying an average rate higher than 30% across your entire taxable income. So that would be the most efficient way to do it, ironically, crystallize more capital gains. But apart from that, I think that's the approach I would take. So thanks very much for your question. And I guess anyone that's very property heavy in their investment approach, that's one of the things is navigating or relying upon income from property is not ideal. You want to have other liquid assets because that income tends to deteriorate. And in some modeling that we do, by the way, it can be pretty aggressive, particularly if you've got all the property in one state, like Listener has, that what we see is, and we can only give our best estimates around future land tax and how that's levied and what the rates will be, but we do see sometimes, and it's not unsurprising that we see sometimes the income declines, the property portfolio income declines just because of land tax. Something to think about. Okay, next question is from Tina. Quick rundown. Tina's 52, husband's 56, both employed for full-time, earning about 180,000 each. Home mortgage is 77,000, so nearly fully paid off. Home's worth 2.5. It's their forever home, but might need to downsize in retirement. Investment property worth 750 with 318 owing against it. Super is 520. Husband is 678. So let's call that 1.2. They have a spare $2,000 a month, but last year of private school fees. So next year they'll have $50,000 to $60,000, and they're hoping to retire in the next few years, but not sure if they can. Okay, and the question is, what should they do? Buy another investment property, sell the existing one, buy a better one, invest in shares, borrow to invest in shares, etc., etc. Well, if we have a look at, we've got 2.1 inside super, and then we've got about 450 pre-tax, let's call it 300,000 after CGT, just roughly, in investment property. So it gives them investment assets of about 1.5 million. So the husband's 56, so we're going to need to require, well, I don't know where the investment property is, like in terms of which state or location, but we're going to need super to fund retirement. So I think the answer is you've got to work another 4 years at least. So they said the next few years. So let's say that's sort of in line with what they're expecting. Then what I would do is the investment property has relatively low gearing against it relative to its value. So it'd still be negative cash flow, but not much. I wouldn't worry too much about repaying the home loan. Just put some cash flow towards it, but it's not a key priority here. So I would just be putting all my spare cash flow into super. So I should have said they're both with, one's with ART, Australian Retirement Trust, 100% in international shares. I like that. Husband's is with Aussie Super, a third in high growth, a third in Australian shares, and a third in international shares. I would either go high growth, all international. Campbell spoke a few months ago about how unattractive the Australian share market is. I think it will continue to underperform international share markets. So I think replicating putting 100% in international shares is probably ideal. Certainly for the wife, given she's 52, 8 years away from retirement, but even arguably for her husband as well. So I'd probably fix up the asset allocation. Then I'd try and move as much money into super, surplus cash flow into super as possible. It's not going to move the dial that much. It's really about performance. So we want that 1.2 that's currently inside super in the next 4 years. Hopefully that grows to sort of 1.7 or 1.8, depending on returns, of course. Now, if they make some contributions along the way as well, then maybe it gets it to 2 million. It's a pretty nice and healthy balance. And then you've got the investment property. Now, I don't know where that is, but eventually you'd want to move that equity into super just because because you want to get rid of the debt, you want to get rid of the hassle of managing investment property, uncertainty around cash flow, and you also want to move that equity into a more tax-effective environment such as super because it's tax-free. And we know, given all the changes that were proposed in the budget, the government is coming after your money and it needs to raise more tax revenue. So super just becomes more and more attractive every time they change the tax rules for trusts or for investment properties, all those sorts of things. So I think focus on, don't worry about the home loan too much. You can withdraw from super to get rid of that, even if there's a small balance by the time you get to age 60. So I wouldn't worry about the home loan too much. Make some repayment, but don't get excited about it. Make sure your asset allocation inside super, particularly your husband's allocation, I'd probably fix that up a little bit. And then I put all your surplus cash flow into super. Use your personal contribution cap fully first. And so after 1 July, that increases to 32,500 each. And then after you've used the personal cap, then make non-concessional contributions and get as much money into super. Make sure it performs really well. Monitor the investment property. Let's see what happens over the next few years, but probably no need to do anything with regard to that. If we have a minimum 30% CGT rate, which is being proposed, then hopefully it's an interesting question whether that minimum 30% relates to the portion that is pre and post 1 July 27, but let's assume it is. In that situation, I used to say, look, don't sell the investment property until you retire because you'll have a lower taxable income. But if that minimum 30% tax remains, then it doesn't really matter that much whether you sell it now or in retirement. But I probably hung on to it at least for another 5 years. And then by that time, the property is probably washing its own face in terms of cash flow, and you potentially just hang on to it for another 5 years, potentially if it's not really taking money out of your pocket and it's not causing you any concern, and if it's still generating capital growth, and then eventually move that money into super. But thanks for the question, Tina. Always love to receive questions, of course. The email address is questions@investopoly.com.au. Again, thank you so much to everyone that has pre-ordered my new book, Wealth by Design. If you're interested in looking at that, the link and including the pre-order bonus is included in the show notes, so you can at the top. So feel free to check that out. But thank you for those that have already pre-ordered. I greatly appreciate the support. And pre-orders are super important now because it determines whether bookstores are even going to stock the book. So you're doing a tremendous job for me by pre-ordering it because it increases the probability of me getting them into bookstores. All right, I might leave it there for today. Tomorrow, I'm going to talk about commercial property investing and how I think commercial property valuations are very unattractive at the moment. And I'll go through, as you would imagine, my evidence-based approach with forming that opinion, and something I've been thinking about. Really, I've been thinking about this episode probably for the last year at least or beyond. Okay, until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.